Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. Here we're talking about understanding balance sheets. Um, kind of the continuation of understanding income statements, where now we're talking about a different financial statement um, involved in financial reporting. Key two topics here are some accounting policies or principles. We're going to talk about some different ways to account for inventory on the balance sheet as well as long-term assets. We'll dive a little bit deeper into financial assets here, which require some different accounting policies depending on the use or the intended use of the assets by the company. And each of these categorizations, both for inventory and long-term assets, will have impacts on income statements, balance sheets, and cash flow statements. So analysts have to be aware of the accounting policies taken by a company in order to fully understand the implications for financial reporting. We'll also touch really briefly on goodwill. We'll talk about how it's created, where it's reflected on the financial statements, and what causes it. And then finally, towards the end, we're going to do some ratio analysis where we're given a balance sheet and we're asked to calculate some liquidity ratios, which are used to measure a company's ability to meet its short-term obligations, as well as some solvency ratios, which are the same kind of concept, but measure how well a company can meet its long-term obligations. So with that, we'll just jump right in. The carrying value of inventories reflects their historical cost, their current value, or the lower of historical cost or net realizable value. Well, two quick distinctions we can make between inventory accounting and IFRS versus GAAP. In IFRS, inventory on the balance sheet, so the asset account, is measured at the lower of either historical cost or net realizable value. And net realizable value is essentially, the cash inflows they can get from a sale, less any costs associated with actually making that sale. So like, shipping, if they have to ship it to the buyer, anything like that. Whereas GAAP, it's at the lower of historical cost or market value. So it's a little bit different. Market value, easiest example would be like an oil company where they have their inventories. Oil, obviously, and then there's like a, actively traded market for that. So once again, it's the lower of these two. So coming back to the question, the carrying value of inventories reflects C, the lower of historical cost or net realizable value. When a company pays its rent in advance, its balance sheet will reflect a reduction in assets and liabilities, assets and equity, or one category of assets and an increase in another. So when a company pays its rent in advance, there's a couple transactions or a couple debits and credits on the balance sheet that we need to make in order to reflect this. So if you're paying your rent, first thing you're gonna do is credit or decrease your cash because you're using cash to pay for it. And then you're gonna debit or increase your prepaid expenses. And this account here is an asset, right? Because we're prepaying for rent, which is, going to give us some future economic benefit. So these two net out, and then we end up, the balance sheet ends up balancing. So to come back to the question, we'll have a reduction in one category of assets, yes, which is cash, and an increase in another, yes, which is the prepaids. So the answer is C. Money received from customers for products to be delivered in the future is recorded as revenue and an asset, asset and a liability, or revenue and a liability. So what's happening here? We're receiving cash in advance so we can work out the transactions. And the first thing we're going to do is we're going to debit or increase cash. And then because they're paying in advance for products, in this case, that haven't been delivered yet, it's actually a liability. So we're going to credit, which is an increase to a liability. We're going to credit unearned revenue. Even though we've received the cash, we haven't actually provided the goods or service yet, so we have to match it using accrual accounting. And it's essentially a liability because we're going to have to perform or deliver these products at some point in the future. So the answer would be, it's recorded as, an asset and a liability. Eventually, like this is outside of the scope of the question, but eventually when the product is delivered, it would look something like this, where you would debit or decrease unearned revenue. So you're reducing it, and then you're gonna credit revenue. It's an increase here because revenue is technically a part of equity on the balance sheet. So yeah, you would increase your revenue, decrease your liability, and this is when revenue is recognized. Moving on, accrued expenses or accrued liabilities are expenses that have been paid, created when another liability is reduced, or expenses that have been reported on the income statement but not yet paid. So yeah, that's exactly what it is, right? Easy example of accrued expenses would be something like this. Let's say I'm creating a balance sheet as of December 31st, and I pay my employees on the 15th of every month. So December 15th, they receive their pay, and January 15th, they're going to receive their next pay. So if I'm creating a balance sheet as of this time, there's 15 days of wages that I've accrued, so that have been earned, but I haven't paid it out in cash yet. So this would be an accrued expense, so it's a liability to the company, and it's going to have to be paid out on the 15th of January. The initial measurement of goodwill is most likely affected by an acquisition's purchase price, the acquired company's book value, or the fair value of the acquirer's assets and liabilities. Um, well, first we can look at what goodwill is. So let's say I'm looking to buy a company and it has 100 million of net identifiable assets. This is like, you know, it could be tangible and intangible assets. You could have some like patents in here as well, um, which of course are intangible. But the key is that they're net identifiable assets. So, assets minus your liabilities, and you take the net. So the company is valued at 100 mil based on its net identifiable assets, but I'm actually going to pay, let's say, 150 mil total to buy the company. And this could be for, various reasons. We could be paying a control premium, which is associated with, acquiring over 50% of the company. There could be, a thorough M&A process going on where we have a lot of different buyers that's bidding up the prices. We could have just valuations through the roof at the time. Could be like a really high growth company, et cetera, et cetera. But for whatever reason, I pay 50 mil more than the net identifiable assets. So this remaining portion, or the difference, is goodwill. So in this case, we would have 50 million of goodwill. So our answer is going to be, it's most likely affected by the acquisition's purchase price. The acquired company's book value, not, really relevant. That identifiable assets uses fair value. And then you can see that we have fair value of, actually, it's the acquirer's assets and liabilities, not the acquiree, like not the target. So they're trying to mix you up a little bit there. But answer is A, the acquisition's purchase price. Here we're talking about some different classifications of financial assets on the balance sheet. So before we get into the question, I'm going to quickly mention the three different types of classifications we can make. One is held HTM, or held to maturity assets. So basically whichever classification is used by the company depends on their use of the asset, what they're using the financial asset for. And the example I typically like to use is like they're holding a bond. It's usually the easiest for me to understand this. So for held to maturity assets, like we said, they're expected to hold it to maturity. So if it's a 3-year bond, they're holding it for the 3 years. So the accounting for this type of asset is as follows. It's on the balance sheet at amortized cost. Any income, so like dividends, interest payments, whatever, goes through profit and loss on the income statement. And then if there's any unrealized gains or losses throughout the life of the asset, they're not recognized anywhere. Not in the income statement, not on the balance sheet, not anywhere. And then if we come down, we have available for sale assets. So this is kind of a mix of holding the asset, but they could also sell it if they wanted to. Here, accounting is as follows. It's on the balance sheet at fair value, which is different than amortized cost. Same kind of concept here with the income. This is actually the same across all three categories. So the income, like any interest or dividends, goes through profit and loss on the income statement. And difference here is for available for sale securities, the unrealized gain and loss goes through other comprehensive income, which is an equity balance sheet account. So it doesn't hit profit and loss, it just goes right to equity on the balance sheet. And then finally, on the opposite end of the spectrum, we have held for trade or held for trading securities. Um, and names kind of self-explanatory. These are assets that the company is looking to buy and maybe sell after a short period of time, so they're actively trading them. Easiest example of this is like a hedge fund that is going to make a lot of active trades with their financial assets. Here, the assets on the balance sheet at market value, like it's assumed, there's an actively traded market for these securities. Maybe there's like active, bond prices in the market that they can use to record these assets on their balance sheet. And then here we have everything goes through profit and loss on the income statement. So the income as well as unrealized gains and losses, everything here goes through profit and loss. So with that, we can come back to the question for financial assets classified as trading securities. How are unrealized gains and losses reflected in shareholders' equity? They are not like this is being a little tricky with it. Like it's technically not recognized in equity, but they flow through the profit and loss into retained earnings on the balance sheet. So the answer is B. Then we have available for sale securities. How are unrealized gains and losses reflected in shareholders' equity? Well, we talked about it right here. They are a component of other comprehensive income. And then finally, assets that are held to maturity. How are unrealized gains and losses reflected in shareholders' equity? They're not recognized at all. We define total asset turnover as revenue divided by average total assets. So revenue over assets. All else equal, impairment write-downs of long-lived assets owned by a company will most likely result in an increase in for that company in the debt-to-equity ratio or total asset turnover. Well, so they give us a bunch of options. So basically what we're asked to do is figure out what an impairment write-down does to these two ratios, total asset turnover and debt-to-equity. So what happens when you actually write down a long-lived assets like PP&E? Let's say, a company has 600 million of property, plant, and equipment, and for whatever reason, maybe they overpaid for it, maybe something happened to the equipment, and it's reasonable to assume that it's now only worth 500 million. So they're going to write an impairment loss in during this period for the difference, right? So it's going to be 100 mil write down or impairment loss to the assets. And then this flows through, this is an expense on the P&L, which means that it impacts net income and eventually flows through to a lower equity amount, right? Because net income flows through to the balance sheet. So to kind of summarize, what happens is one, your assets decrease by the amount of the write down, so the 100 mil, and then also your net income and your equity decrease. It's not the net income and equity don't exactly decrease by the 100 mil because there's the tax benefits of, well, not necessarily benefit, but this expense is tax deductible, but we can ignore the tax impact for this question. But just looking at these ratios, if assets are decreasing here, this whole ratio is going to increase. And if equity is decreasing, this whole ratio is going to increase as well. So looking at the answers, the impairment will most likely result in an increase in both the debt to equity ratio and the total asset turnover ratio. Here we have a couple balance sheets. We have a balance sheet for company A, company B, and the sector average. Kind of standard balance sheet. We have current assets, total assets, current liabilities, etc. And in this question, we're asked, based on Exhibit 1, which statement is most likely correct? Company A has below average liquidity risk, Company B has above average solvency risk, or Company A has made one or more acquisitions. Really quickly, liquidity risk is the risk of meeting short-term obligations. So, some ratios that we could use to analyze liquidity risk would be like the current ratio, which is current assets over current liabilities, maybe the cash ratio, which is just, cash divided by current liabilities. So it's basically looking at how much cash or assets that can be quickly converted into cash the company has to meet its current liabilities. Whereas solvency risk is more associated with meeting long-term obligations, so like your long-term debt. And then some ratios you could use to analyze solvency risk would be like, total debt over equity, total debt over assets, stuff like that. So just looking at the balance sheets, we could actually, we can kind of take the shortcut here. And if you look at answer C, which doesn't require any calculations, company A has made one or more acquisitions. We can see on company A's balance sheet that it has goodwill of 25. So this goodwill is going to have to come from acquisitions, right? It can't just come out of nowhere. It comes from acquisitions. So we could actually take a shortcut and just know that the answer is C, and that would save you a lot of time. But we can look at answer A just for the sake of explanation, where we're looking at liquidity risk. So we can look at the current ratio, which is current assets over current liabilities. And we have for company A, current assets 35, current liabilities 35. So the ratio is actually 1 versus the sector average, which is 48 in current assets and 28 in current liabilities. So let's call it like 48 over 28, call it, I don't know, 1.8 roughly. So for this company, it has below average liquidity risk, right? Like you can actually see that we have less assets on hand to cover our current assets versus the sector average, which has more assets on hand. So in this case, we would actually have above average liquidity risk. So we could actually cross that one out. One quick thing to note is that, sometimes with these current ratios or, liquidity ratios or solvency ratios, two different metrics might provide conflicting results. So, you could have a current ratio which looks good and then like a quick ratio that doesn't look good. It just depends how, the shift of or the proportions that, different current assets make up. So like if there's more cash on hand, your cash ratio is going to look good. If you have a lot of inventory, then it's going to, you know, if you have a lot of inventory but no cash, and your current ratio might look good, but not your cash ratio, etc. So it's up to the discretion of the analyst to make these decisions at the end of the day and compare a bunch of different ratios. Look at the company's overall operations to really assess liquidity risk and solvency risk. The ratios help, but they're not the end all. Same data set. Next question. The quick ratio for company A is closest to which one? So the quick ratio is a little bit different than the um, current ratio. So the quick ratio is a bit more stringent, and it just takes assets that are either cash or can be quickly converted into cash and includes those as current assets. So that would be your cash, your marketable securities, and marketable securities are pretty much, they could be like redeemable GICs that the company is investing in the bank just to earn like, 2, 3%, 4%, whatever. Instead of having cash sitting around and earning nothing, they might invest in like redeemable GICs where, like I said, they're earning a little bit of interest and they can redeem them at any time. So it's pretty much the same as cash. Like, this could effectively be cash in like a day or two, maybe even the same day. And the quick ratio also includes accounts receivable, which, in theory should be able to be converted quickly into cash, but, obviously depends on the company's customers, like what their payment terms are, etc. But for the quick ratio, it does include accounts receivable as well. So it's 5 in cash, 5 in marketable securities, 5 in accounts receivable. And we divide this by current liabilities, which is 35. So we have 15 over 35, and our answer is A, 0.43. Based on the same exhibit, the financial leverage ratio for company B is closest to what? So the financial leverage ratio is total assets over equity. So for company B, that is 100 over, sorry, shareholders' equity 45. So 100 over 45, which is 2.22. Last question, which ratio indicates lower liquidity risk for company A compared to company B? So this is kind of what I was saying a bit earlier, right? Where different ratios can provide different answers. But regardless, we can just go one by one. So for A, the cash ratio, this time it's even more strict than the quick ratio. So it's just cash and marketable securities are included. So for company A, it is 5 plus 5, so 5 in cash, 5 in marketable securities over current liabilities, which is 35. And for B, it is 5 and 0, 5 plus 0 over 25. So for B, this is going to be equal to 5 over 25, 0.2. And then for A, it's 10 over 35, which is 0.28. So we actually got lucky just going from top to bottom because this is actually the answer. We can see because the cash ratio is higher for company A, this indicates lower liquidity risk. So they have more cash on hand in order to fulfill their current liabilities, whereas 0.2 for B is lower, so they have less cash on hand. According to the cash ratio, they have company B has higher liquidity risk. We could look at C really quickly just to kind of show you what I was saying about conflicting results. So for the current ratio for A, it's 35 over 35, it's 1, and for B, it's 55 over 25, which is like 2.2 or something. So here, we're actually showing higher liquidity risk for company A and lower liquidity risk for company B because company B has more current assets on hand to fulfill its current liabilities.